Every time we talk, I mean, I'm always curious about these kind of, these neoclouds and whether kind of these sort of ancillary players in the hyperscaler space are actually legit. When you look at these numbers today, does it give you a little bit more sense of proof of life or what?
It's incrementally positive. There is still a really big question about whether we even need neoclouds, whether they're a good business. At the base of it is, are they getting a good enough return on investment to pay for the very expensive capital that they have to borrow? And I think that what investors are seeing today is they took a small step in the right direction. Their operating margins, which were only 1% last quarter, are now 5%. So that's not a lot. That still means a 1% return on invested capital, but it's a step in the right direction.
So a step in the right direction. Is it a durable step, a long-term step, Gil, or is this just, they're taking advantage of what right now is just kind of a crazy market?
Let's put it in perspective. So if I'm saying they're getting about a 1% return on assets, their borrowing cost has actually just gone up. It was closer to 8%, and now it's close to 10%. So you're borrowing at 10% to get a 1% return. That's not good news. So again, they have to improve the returns very significantly, and they have to reduce the cost of capital, which recently has actually gone the wrong way. That's why we're questioning the whole category, is that this is like borrowing on margin to buy treasuries. Borrowing at 10% to buy a 5% return isn't a good idea. And for these guys, again, they're still getting a 1% return. So and they're at a 10 billion revenue run rate scale. So it's not like there's a tiny upstart, and they're still generating pretty low returns on that. Slightly better than before, but still not good enough to justify their existence.
Well, what do you make of kind of the splashy announcement that Jensen Huang made yesterday, the idea of trying to raise what is effectively a $500 billion financing pool, if you will, for presumably those folks who are going to be buying its chips. But the idea is that some of these companies that are dealing with a higher cost of capital or maybe no access at all would potentially have access. Does that not help CoreWeave, or is this just basically you're still paying the same cost of capital, just maybe to a different set of separate set of lenders?
That is exactly what Jensen's trying to do. He's seeing CoreWeave have to borrow at 10%. He said, I need to do something about this. And so if I guarantee some of these loans, I can reduce the cost of capital for companies like CoreWeave. So he is trying to help them. The price is, of course, that you can only buy NVIDIA chips. So he's not doing it out of the generosity of his heart. He's doing it so he can seed the whole ecosystem with capital that's tied to buying NVIDIA chips, not Broadcom chips, not AMD chips, not ones made by Intel, but NVIDIA chips. And so that he's getting something for that backstop. That backstop, though, is a financial commitment. If these data centers fail, the loan goes back to NVIDIA. So there is a cost, at least down the line, for them making this type of guarantee. But for now, they have $60 billion of net cash. They're going to generate $200 billion in the next 12 months. He needs to do something with that cash, and guaranteeing his customers' loan seems to be a good way for him to make sure that they keep buying NVIDIA and don't buy anything else.
So with CoreWeave, I mean, one of the big questions, and that you and a lot of other analysts raised, was also this idea of who their customers are and whether it will be able to diversify. Obviously, at least in the most recent quarter, still heavily dependent on Microsoft. And it's honestly a couple other hyperscalers. And I guess my question to you is, why does a Microsoft need a CoreWeave? Why does a Meta need a CoreWeave? Why does Alphabet need a CoreWeave or any of those other neocloud competitors?
So the reason Microsoft has a three-part strategy is that they don't want to build it all themselves. If they build it all themselves, they're taking a risk that they overbuild. So they're building some infrastructure, they're leasing other infrastructure, and then they're leasing compute from companies like CoreWeave and reselling it to their customers. They're the ones that have the customers, and that's why they want to make sure they can meet demand without overinvesting, and CoreWeave is a tool to do that. The problem with being a tool is that once you use the tool for, let's say, the next 3 to 5 years, by then Microsoft believes they will have enough capacity to serve all their customers. Are they going to need CoreWeave? Is Meta going to need CoreWeave when they're done building out their own infrastructure? So this is great for Microsoft and Meta. For CoreWeave shareholders, there may be a ticking time clock.